Here's a mind-blowing fact. Choosing the wrong retirement account could literally cost you hundreds of thousands of dollars over your lifetime. I'm talking about the difference between retiring with $800,000 versus $1.2 million, same contributions, different accounts. Today we're settling the Roth IRA versus 401k debate once and for all, and I guarantee by the end of this video, you'll know exactly which one is right for your situation. Welcome back to Cashflow Kingdom, where we break down personal finance in plain English. I'm your host, and if you're tired of being confused about retirement accounts, you're in the right place. In the next 11 minutes, we're going to compare Roth IRAs and 401 Burmese Chats side by side, show you the math behind each choice, and give you a simple decision framework that works whether you're 22 or 52. Let's dive in. Let's start with the fundamentals because I know some of you are thinking, what's the actual difference? A 401k is your employer-sponsored retirement account. You contribute pre-tax dollars, meaning you get a tax deduction now, but you'll pay taxes when you withdraw in retirement. Think of it as pay taxes later. A Roth IRA is an individual retirement account that you open yourself. You contribute after-tax dollars, no immediate tax break, but here's the magic: you never pay taxes on that money again, including all the growth. That's pay taxes now. Both accounts let your money grow tax-free while it's invested, which is why they're so powerful compared to regular investment accounts. The key difference is timing. Do you want to save on taxes now or later? But here's where it gets interesting: the answer isn't always obvious. Let's talk about why 401 Burmese Chats can be absolutely incredible. First, employer matching. This is literally free money. If your company matches 50% of your contributions up to 6% of your salary, that's an instant 50% return on your investment. You cannot beat that anywhere else. Even if you're torn between accounts, always contribute enough to get the full match first. Second, the contribution limits are massive. In 2024, you can put away $23,000 per year, and if you're 50 or older, you get an additional $7,500 catch-up contribution. That's $30,500 total. Compare that to a Roth IRA's $7,000 limit or $8,000 if you're over 50. If you're a high earner wanting to save aggressively, the 401k gives you way more room. Plus, that immediate tax deduction can be huge if you're in a high tax bracket now. Now here's where Roth IRAs get really exciting. Remember, you're paying taxes on the seed, not the harvest. Let's say you contribute $6,000 per year for 30 years, that's $180,000 total. But with compound growth averaging 7% annually, that account could be worth over $600,000. With a Roth IRA, you pay zero taxes on that $420,000 in growth. Zero. Forever. Plus, Roth IRAs have no required minimum distributions. Your 401k forces you to start withdrawing at 73 whether you want to or not, but a Roth IRA? You can let it grow until you die and pass it to your kids tax-free. And here's a secret benefit most people don't know: you can withdraw your contributions anytime, penalty-free. Not the growth, but your original contributions. So if you put in $30,000 over 5 years, you can take out that $30,000 if you need it for an emergency. If this breakdown is helping you make sense of retirement accounts, hit that like button and subscribe for new money tips every Tuesday. Here's where things get tricky, and this trips up a lot of people. Roth IRAs have income limits. If you're single and make more than $138,000, or married filing jointly making more than $218,000, you start getting phased out of Roth IRA eligibility. Make too much, and you're completely locked out. But there's a workaround called a backdoor Roth conversion. We'll save that for another video. 401 Burmese Chats don't have income limits for contributions, but here's the catch: if you make too much money, you might not get that tax deduction I mentioned earlier. Also, 401k investment options are limited to whatever your employer chooses, usually 10 to 30 funds. With a Roth IRA, you can invest in virtually anything: individual stocks, ETFs, bonds, REITs, you name it. This flexibility can be huge for building a diversified portfolio. Your age and career stage dramatically affect this decision. If you're in your 20s or early 30s, you're probably in a lower tax bracket now than you'll be in retirement, especially if you're just starting out. This makes Roth IRAs incredibly attractive because you're paying taxes at today's lower rate and avoiding taxes when you're potentially in a higher bracket later. But if you're in your 40s or 50s hitting peak earning years, that immediate 401k tax deduction might save you thousands right now. You're in a high bracket today and might be in a lower bracket in retirement. However, and this is important, tax rates historically tend to go up over time, not down. If you believe taxes will be higher in 20 to 30 years, paying them now with a Roth starts looking pretty smart regardless of your current age. Let's run some real numbers to make this concrete. Meet Sarah, age 25, making $50,000 per year. She's in the 22% tax bracket. If she puts $6,000 into a 401k, she saves $1,320 in taxes this year. If she puts it in a Roth IRA, she pays the full $1,320 in taxes now. Fast forward 40 years, that $6,000 grew to about $130,000 assuming 7% returns. With the 401k, she pays taxes on all $130,000 when she withdraws it. If she's in the same 22% tax bracket, that's $28,600 in taxes, leaving her with $101,400. With the Roth IRA, she keeps the full $130,000 tax-free. The difference? Nearly $29,000 on just 1 year's contribution. Now imagine that compounded over 40 years of contributions, we're talking six-figure differences in your retirement wealth. This is why understanding these accounts matters so much. Alright, here's my simple decision tree that works for 90% of people. First, always contribute enough to your 401k to get the full employer match. This is non-negotiable free money. After that, if you're in the 12% tax bracket or lower, lean heavily toward Roth IRA contributions. If you're in the 24% bracket or higher, traditional 401k contributions probably make more sense. If you're in the 22% bracket, the gray area, consider splitting your contributions between both. And here's the thing most financial advisors won't tell you: you don't have to choose just one. You can contribute to both a 401k and a Roth IRA in the same year, up to their respective limits. This gives you tax diversification, which is just as important as investment diversification. Remember though, this is general guidance based on common scenarios, not personalized financial advice for your specific situation. Here's your action plan. First, figure out your current tax bracket. Second, check if your employer offers 401k matching and contribute enough to get it all. Third, decide whether you want to pay taxes now or later based on where you think your tax rate is headed. And fourth, don't overthink it. The most important thing is that you're saving for retirement at all. Start with whichever account makes the most sense today, and you can always adjust your strategy as your income changes. Drop a comment below and tell me which account you're leaning toward and why. And if you want more retirement planning content, check out my video on IRA contribution limits right here. Thanks for watching Cashflow Kingdom, and I'll see you next Tuesday.